Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. Happy Halloween. I think I'm going to go as a frustrated trend follower who can't believe the bevy of short rate positions I had on. Saw a massive reversal this month, with rates shooting up despite the Fed's first cut in 4.5 years. You think the kids will get that one? Anyway, okay, on to the episode, where we went outside the normal trend, vol, future space, and talk with a pros pro in the structured credit and insurance space, with Peter Polanskyj of Obra Capital joining us. We get into a lot of good stuff with Peter, including just what all that means, structured credit, insurance, Peter's background, some of the cool deals he's done, and more. And while the terminology, access points, markets, and more are as different as you might expect, the end result is trying to be the same as the other alts folks we have on here. Searching for non-correlated returns with a great risk-return profile. I think we can all speak that language. Send it. This episode is brought to you by RCM's Outsourced Trading Group. Starting up an ETF and need efficient futures market access? Have a unique options trading strategy that needs the orders to be handled with care? Or just sick of the cost and hassle of running your own trade desk in-house? RCM's 24/6 Outsourced Trading Group could be the answer, letting you offload as many trade execution pain points as needed. Check it out at rcmalts.com/24. Now, back to the show. All right, welcome back, everyone. We're here with Peter Polanskyj of Obra Capital. How are you, Peter?
Great. How are you doing?
I'm great. Where are you? New York?
I'm in New York, in our office in Midtown, right by Rock Center.
All right. You guys always been there or bounced around?
Our New York office has always been in this area. We have offices in Vermont, several in Texas, and one in Kansas City. So the firm is kind of spread out, but we in New York have been in this office for a while now.
Vermont seems like the outlier there. There was just one guy who said, "I'm not leaving my farm. I want an office in Vermont."
We actually have a whole credit team up in Vermont, and so there was a pretty an established credit manager that had a really long history of being up there, and so we figured the team was there was a team up there. They were together. They were cohesive. We didn't want to mess with it, and so we kind of liked the credit culture and thought it was a good idea to leave them up there. They work closely with us here in New York, and so that is I think a decision on our part to not mess with things that are not broken, right? So
got it. Love it. And so I'm not going to lie, I get excited about hearing all the cool stuff you guys are doing, but my head also spins around a bit. I'm just an old stupid futures trader here, so right, I don't know a lot of the lingo, the acronyms and whatnot. So if you could, let's just kind of go up with a 50,000-foot view. All right, is it insurance? Is it credit? Is it both? Is it structured products? So all those terms kind of get commingled, if you will, in my brain. So let's let you take the floor for a minute and give us the 50,000-foot view of what you guys are, what you guys are doing, and then we'll dig in from there.
Absolutely. I think they get commingled in my mind too. So I'll try to keep it, it simple. So Obra Capital is a $4 billion asset manager, and it has kind of a variety of vehicles, and we split our business kind of essentially in two very big buckets. One is insurance and one is credit. And so on the insurance side, we have largely opportunistic vehicles, so like private equity style funds and hedge funds that focus on two things. One is longevity, and so we invest in products where the returns are driven by longevity and mortality. And I think the way that we prosecute that space a little differently is that we do transactions that are both kind of long and short mortality, if you will. And so that's atypical in this space, I think, or at least we think it's unique. And so that's kind of how we operate in that vertical. We can do reinsurance transactions, or we can just buy assets. But the idea is to run a book that is kind of balanced in terms of its exposure. On the insurance special sit side, we have a fund that just basically is a provider of capital to the insurance and financial services industry. So we can lend, we can invest in equity, we can do kind of a variety of transactions. We're kind of form agnostic, but it's somehow, some way making capital available to insurance or financial services in a variety of ways. And so again, that's a newer of the two efforts. Longevity's been around probably since 2009, and the insurance specialists, well, we've been doing it for the better part of probably 7 years or so. We didn't have a dedicated fund until I joined the firm about 3 years ago when we launched a dedicated fund. So that dedicated fund has is we had did the first close there, and then we're going to have a second fund coming in that space as well. And so
Awesome.
kind of a good split. But all those kind of strategies are opportunistic. They're looking for kind of
Yeah. You
decent returns.
want me to dig into those now and ask questions? Or you want to go through the credit side, then we'll circle back?
Maybe I'll go through the credit side and then we
Yeah,
can
yeah.
circle back. Yeah. So I think so. If you think about the insurance vertical, it's a highly specialized space. Like you have to there's a lot of regulatory issues. There's a lot of kind of understanding that even just the underlying risk, right? And so because of that, it's a very kind of specialized asset class. And so I think on the credit side, we try to take a similar approach. The idea there is really to touch parts of the market where it requires kind of a relatively sophisticated level of understanding to underwrite them, but in markets where maybe the largest institutions in the world won't find them attractive because they're not big enough of opportunities. And so we kind of think you need the kind of the world class level of sophistication to attack these markets, but the market size for those markets isn't big enough where we're competing with the people who have those skill sets as well. And so I'll just kind of go through the various categories that we have. But the first one is just multi-sector credit, where we deploy largely to like structured products, ABS, commercial mortgages, other forms of structured products, which are generally things that are backed by pools of assets. So the underlying assets could be anything, right? Especially in the ABS space, it could be loans to people, it could be car loans, it could be solar things, it could be lease payments, could be royalty payments, but it's there's an underlying asset that you're then kind of somehow lending against. We do that both in public markets where we can trade securities, but we also do it on the private side where we bilaterally negotiate transactions with people on an individual level. So we take the same kind of underwriting skill set across all those spaces, which again requires a decent breadth of capabilities, and apply it both to the public markets and private markets in kind of in an equal way.
Quick definition there: ABS, asset-backed securities.
Asset-backed securities. So that'd be like things like I was saying, like could be royalties that are underlying. It could be lease payments. Could be consumer debt. Could be small small medium enterprise debt. It could be any kind of asset that has regular cash flow. You can basically put into these vehicles, and then you can try to kind of create a structure around them. And so it tends to be a very diverse space. Is the answer. So you need to have the flexibility and capability to go look at all these different underlying assets and somehow underwrite them, which is why again we think of it as a pretty specialized space, because you have to be able to go underwrite whatever consumer auto loans at the same time as you're as you're looking at royalty payments on kind of pharmaceuticals or something like that. And so that's the biggest kind of the biggest category. That's the most broad. The next couple, institutional credit, we do high yield loans and high yield bonds in the form of CLOs. And so the specialty thing isn't necessarily the underlying bonds and loans. Those are pretty normal to kind of high yield companies. But the vehicle in which we do it is a specialized structure. So it's like the vehicle we use to invest has structuring around it and has specialty aspects to it. But that's just probably a space where we're the most kind of normal, if you will, right? Where we do the most typical thing.
And CLO, collateralized loan obligation.
Sorry, collateralized loan obligations. Sorry for the nomenclature.
I'm pulling way back to my Series 7 book myself. So yeah.
So again, you issue kind of a collateralized loan obligation where you issue different tranches, so you kind of structure up the various liabilities of that fund, and so that is again the more specialty part of it, is managing around the rules of that fund that are created by by that structure that exists, right? So we can't just go out buy whatever loans we want. We have to buy certain credit quality, certain characteristics, and operating within that rule framework is kind of the specialty part of this space, right? It's not so much while the underwriting of the credit is by no means trivial. That's a more typical activity that you see a lot of asset managers do.
Yeah.
The managing it in the form of a collateralized loan obligation is kind of what makes it a little bit more unique, I guess, is what I would say.
So it's a little bit like stock picking, but on their on their liability side and then putting it into the CLO.
Yeah, exactly. We're picking credits we like, not stocks we like. But exactly right. That's exactly right. And so it's like that's fine. That's like fairly normal, every day. A lot of people do that stuff. But the actual complexity comes in that the vehicle itself is actually complex, right? And the rules of the road are complex. The next bucket's asset-based opportunistic credit, and so that would be like, again, very similar to the asset-backed securities market, but just not in securities form. So here you could have, a variety of things. Could be consumer finance, could be litigation finance, could be other kind of other assets. So here we have, again, we have some consumer products that we do that are where we like warehouse them or provide financing to the originators of those. We have litigation finance where we finance, kind of the acquisition of claimants for particular lawsuits, and other things like that. So you can think of it as private credit, but it's private credit where it's not like the CLO part. You're not lending to corporates. There's something else, in a simple credit way. You're like, there's some asset there that you're using as collateral that's somehow different, and somehow you're finding a way to get collateral value from that asset, not from the kind of credit quality of the borrower per se.
An asset, is that in air quotes?
No, I mean,
it's not like you can't go repossess it. It's more of a revenue stream or something like that.
I mean, yeah. So a lot of times the assets are financial assets. So like in litigation finance, for example, that's entirely a financial asset. But in things like auto finance, if you're providing a warehouse to a subprime auto lender, as example, we have one of those in house, right? Then while it's a loan, ultimately is the first piece of collateral. The ultimate piece of collateral is actually a car, right? And so there is we have some, we bought a book from someone which had a bunch of loans in it, but it also had some autos in it, right? Actual cars, right? And so while the
let me know if that's defaults and I can get a deal on something cool.
That's the first question I asked. I was like, hey, what kind of cars are there in that portfolio? But I think normally it's some kind of financial asset, but normally underlying it there can be an actual physical asset that again was the original source of value that's being lent against. So it can go both ways, right? But I think the big thing there is you're not just relying on the credit quality of the borrower, right? You're relying on something else, whether it be, some receivable payment they own, which would be a financial asset, or some hard asset that they actually have. But you're somehow, and then you're normally designing the structure around the kind of cash flow characteristics of those assets. So if it has, if it's like, let's just say it's a car loan that that amortizes down, right, like a mortgage, then you would structure your deal around those kind of cash flows as opposed to like, something that was more just paid interest or something like that, right? And so you have a different structure if that were the case. And so that's probably where there's the most kind of unique. Here's where there's a lot of unique structuring going on. The last category is real estate credit, and there we focus on transitional loan, like relatively short-term loans for situations where there's a sponsor who's going to make some change to the property, and it's normally on habitational or multifamily or mixed use properties. So like, there's a rental building that's near a college campus that is not currently being leased to students. The sponsor wants to improve it, and then rent it to students, and they think they can get a better rent outcome if they do that. And so we would kind of provide them financing that allows them to do that. Again, here, that financing would be structured, so we may say something like, we will lend you X dollars on day one, and then after you've invested some more money in the property, we'll lend you more money because you've invested more assets, more money into the property. And after you meet some rental hurdle, we might lend you a little more to finish off all the improvements you want to do. And so again, there you can hear it's not just you don't just make a loan and then kind of wait, right? You make a loan and there's like follow on, kind of assessment of the risk. There's follow on monitoring of what's going on, and I think again, kind of broadly fits with the other things we do, and that it's fairly engaged, right? You're not just kind of writing a check and going home. You kind of write a check
for the best.
Yeah, exactly. You're kind of like in almost all these products. there's some level of engagement post funding, right, where you're either monitoring or tracking or assessing, and making either making more capital available or making less capital available depending on what you're seeing. But there's some kind of active investment process going on post the initial funding.
It's almost like maybe we'll coin a new term, partnership credit,
Yeah, well,
right?
sure, yeah, yeah.
Sort of
That's not a bad way of putting it, right?
involved credit. Maybe that's a
Yeah,
good one. Yeah,
yeah.
involved. Let's get into your background, because how do you keep this all straight in your head? Like I'm saying, right? Like all these verticals. I guess you're saying like they all at the end of the day kind of look like the same thing, and you're just accessing them through these different channels. Um,
Yeah,
yeah.
so I'll give you my background. I guess I'll tell you how we think about it. But my background is I started out life in the '90s. I was a property casualty actuary, so I was an actuary in the insurance space. And then where I worked on, I worked in what's called
And
sorry,
actually like dreaming of becoming a hedge fund manager, or how did
yeah,
that, let's get into
yeah.
that, right?
I was a math major, and
That's probably a one of actuaries that actually move up the chain.
yeah, I mean, I was a math major, and then it was like, what do you do when you're a math major? And
Yeah.
I was pure math. It wasn't applied math. It was like, go prove this statement, right? And so you like took a bunch of like x to the t and x to the n, and prove something. Um, and so what do you do with that? Everyone says you become an actuary. So that's kind of where I went. And so I started doing that. And actually, I worked on I was in my role, I worked on a catastrophe bond,
Hmm.
right? Which is one of the ways in which insurance crosses over into capital markets, right? One of the early ways actually that insurance crossed over to capital markets. And so I worked on that from the insurance side. And I kind of said to myself, like, if you can do this, which is like it's really hard to analyze, like how likely are hurricanes and earthquakes and all that stuff. Then like
Very.
if you can do that and you can turn that into a bond, there must be a bunch of other things that are going on that look like this and require like the kind of the math skills that I had, and so that's when I kind of headed toward business school and then to Morgan Stanley, and so I at Morgan Stanley, I ended up going to Columbia for business school, and then I joined Morgan Stanley as a strategist, but I was focused on credit derivatives, structured credit, and things like that. So I sat with people who were very kind of fundamentally driven, like the high yield, trading
Mhm.
desk is a very fundamental place where people look at companies and say, like, I think this company can pay this back or not. But I was like a quantity guy in that space, and so it was kind of this mixed world of fundamental like credit work, and then applying it, kind of in derivatives fashion, right? And so using the tools of the derivatives world to do things in that space. And so I was
Like based off their default rates and things of that nature, plus
yeah,
their,
I think based
yeah.
on fundamental views, you could say like, hey, the market by its pricing thinks X, right?
But
But
you're right. They
but
think it's a 20% chance of
yeah,
default, but
exactly.
you guys are telling me it's a 10% chance. There's
And so you can position that, right? You can position,
right, right.
right? It might be some complex strategy that require to isolate that difference, but you can somehow position it. I think, in equities, right, in futures and all that stuff, or sorry, in commodities and in forex and all these things, like those option strategies are well understood, well defined. They've been doing them for whatever 55, 50, 60, 70 years or longer than that.
Yeah.
In credit, this stuff didn't, it wasn't that trafficked in, right? And so the idea that you could trade like a constant 3-year maturity credit instrument, that didn't exist until kind of until the 2000s, right? Because
Hmm.
you have a bond, you buy a particular bond, that has its terms, it has a maturity, has a coupon. That's different than buying a stock, right? Because a stock is fungible with every other stock. That particular bond, there might be 15 bonds in the capital structure, and they all look different. And so the idea that credit was the first place where you could actually kind of generically trade the credit of a company, and so then all these kind of derivative strategies were built up around that, and so that's what I worked on in the
Do you
2000s.
think, just quick interjection there, do you think that if it was so new and people were rushing into it in the early 2000s, like that's what that caused '08? Like too much complexity too fast, or no?
No, I mean, I would like, I think the what if you look at a lot of this, like CLOs, for example, in it, through and a lot of the kind of what I would call first order type
Yeah.
securitizations, they all worked, Like the best performing CLOs ever were the ones done right before the crisis, right? Because the managers could reinvest in cheap assets and create a bunch of value. And so they generally worked. When it was, I think what for my mind, what drove that out, what drove a lot of that was when you did it on like second order things. You know, you took like a derivative of a derivative, right? That's where I think you ran into problems, right? That's where you had problems. I think all the first order stuff generally performed as it should, right, in the market environment and with the outcome you had. Like, so if you did a mortgage securitization and a bunch of mortgages defaulted, yeah, the guys at the bottom of the stack, they're
Got
supposed to
hit.
feel some
Yeah.
pain. Yeah, that's supposed to happen, right? And then so that, I think that all like functioned, but I think it was when you added like extra layers,
And leverage. Yeah.
yeah, and that's when you really had problems. But like a lot of products, kind of did what they were supposed to do. Obviously, you had economic problems, but the things reacted the way you would have expected them to in most cases, and then there are some exceptions to that, obviously, right? And so I think
Got
like
it.
it's not just that was that would be like the cause. I think it's kind of like when you start doing things that like are hard for people to actually underwrite, that's where you kind of end up with problems, right? So anyway,
Yeah.
I was there from 2002 to 2008, and then 2008 I joined Oxif, and I was responsible for investing in a lot of those products as they were you know as they were trading very cheaply. And so we saw a lot of them come back because that was a lot of them ended up fundamentally performing, right? And so, but
Yeah.
you had to dig in deep and do a lot of analysis to get that. And so I was doing that, and in 2012 we launched the CLO Manager. I was involved in the launch of that and worked very closely with the team there. I was ultimately running that business when I left to join Obra. And so you can hear from my background that was fundamentally like you're buying individual loans in that business. Again, where the vehicles are kind of complex. So that was the fundamental credit um, kind of responsibility. So you can hear I was doing, I had insurance, I had kind of a quantitative credit
Then
thing,
derivative.
and
Yeah.
then fundamental credit as well. So I kind of touch all these markets, and so like, that's how Blair Wallace, the CEO here, when he was kind of we were talking about me joining, he was like, look, we do all these things that you've done, and so and so he thought it was a good fit, and I agree, and I think obviously nobody can be a master of everything, right? Like you have to have your
Yeah.
specialties, but I think the team here, um, people touch the various parts of this. So we have like people who are bankers but who focus on insurance as a banker, or and so they touch both sides of the equation, right? Or other things like that where you're kind of multifaceted in your experience, and I think that proves to be super helpful because a lot of the things we do are they're multidimensional, right? And so, for example, in longevity, you care about the payor, you care about how good the quality of the insurance company is, right? That's one of your risks that they just don't pay you, right? And so
Yeah.
you care about how good that company is. In most cases, it's very high quality, and you also care about like when these payments are going to happen. And so those are underwriting the credit quality of the counterparty that's going to pay you, and underwriting the when these cash flows are going to happen are like two very disparate skill sets, right?
Mm.
And so no one's going to be able to master both of them, but we have members of our team who specialize on one side and have seen the other, right? And so they know kind of where to bring the other specialist in, or how to loop it in, and how to kind of how to bring in the right parts of the firm when necessary. And I think that's kind of the key thing here, is that you have to be able to do. In our specialist business, the same thing. Our specialist business, we often describe it as we live in the giant cavern between insurance and credit. And what we mean by that is insurance people generally hate counterparty risk, right? They hate like
Yeah.
or they're not allowed to take it for regulatory, right? So if you are an insurance company and you have a big deductible to some individual company, they will say you have to collateral. Your regulator will tell you you need to collateralize that. You can't just trust that that company will pay you, right? Those deductible amounts. And on the credit side,
Because
right?
then you can't pay the mom and pops, right?
Yeah,
The
yeah,
average
exactly.
folks.
That's right.
Yeah.
Your job isn't to take credit risk. It's take insurance risk, and so you're not supposed to do that, and they don't, right? And so most risk takers on that side that's kind of where the line is. They just go, oh, I don't do counterparty credit risk, right? That's not our job. And then the credit people will say like, look, I want to look at EBITDA and company financials and all these fundamental like, financial characteristics. I don't
But
want to talk to you about, how likely a policy is to lapse if
yeah,
that's the like collateral I'm taking, or is this going to are people going to decide to cancel their policies, or will they do other things, or will medical insurance be outstanding for 6 months versus 3 years? Like those are things that are different toolkits to underwrite. So you
and
kind of
so
need
at
to,
a place like I don't even know who does both, but John Hancock popped in my brain.
yeah.
Right, those are basically two different floors. Like there's the insurance floor, there's the credit floor. They don't
I
they
I
don't meet for lunch.
I don't know, but I think I
Yeah.
conceptually, yes, I agree with you. And so I think we try to bring that together, right? Is really what we try to do. And so that I think that's the special, if you will, that's a special sauce because there isn't a lot of competition in that market where those two things, where you have both of things together, because there's plenty of to do without having to like look at the combined things. We think there are niches where if you're willing to look at the combined things, there's great value, right? And we think the value is in that complexity, right? You can do things that are very high quality credit risk and exist because of for a variety of reasons that are kind of structural to the industry. And that thing, it might not be, it's not going to return 40%. It might return 10%, but that's a really good 10%, right? And so because maybe the counterparty trades at 6 or 5 or something like that. And so we think there's a lot of value to be had in that, and that's what we do. Like the name Obra, right? It's like loosely translates to work. And I think the idea behind that when we took
Do
that
the
name
work.
was say, yeah, we're willing to do the hard work, right? We'll like go dig, go find the value, and so we tend to see all these, and especially insurance, right? There's a lot of, like if there's an insurance situation that's, I'm not going to say like stress. Let's say it's stressed. Like that's a like there aren't a lot of people who look at those right situations. Like most of the insurance industry does not want to deal with some kind of financial stress. They're going to go miles away from it. We see lots of those because we're precisely the guys who will kind of roll up our sleeves and dig and see if there's a way to kind of make it, make value there somehow, right? And
Right.
so
But you're not a distressed debt hedge fund, right?
no, no,
Like
no,
so
no,
yeah,
no.
that's where it gets confusing. But and how does an insurance get stressed, quote unquote?
No, it could be as simple as like right now in Florida, there's
Mm,
probably insurers
yeah.
that are stressed from the hurricanes, right? And it doesn't mean that they're not, like it's not distress, right? It's just
Yeah,
that
yeah.
they have there might be a lot of claims coming, right? Unless and so like, how do you manage that? How do you deal with that process? Can you do things around the
Right.
edges that help that process? That's kind of
So if
the
they have
kind
a
of
billion-dollar pool and they're gonna get 950 million of it called, they're
yeah,
they're
exactly
stressed.
right. It's like
Getting two
the like
billion called is distressed. Yeah.
yeah, there might be like liquidity, might be liquidity problem issue or something like that, right? So
Mm.
I guess I'm not trying to say that that's coming by any
Yeah,
shape
no,
or
no.
form.
Yeah.
I'm just saying like that's the kind of thing. If you have a big event and you have to pay out and people have money invested, they may look for a solution to deal with that, and that's kind of where we get phone calls, right? And so and then there's this regular way stuff too, where there's hey, I want to, I have a bunch of kind of risk on in some part of the market. I think this other part's super interesting. So can I find a way to kind of lighten my capital load in the part that I find less interesting and move to that, super interesting part over there? Like, can I grow over there somehow? And for that, they might need outside capital or they might need a partner to take some of that risk or a variety of things. And so I think there's a kind of, there's this, it's always happening, right? But but there's always uniqueness and it's normally bilaterally negotiated and you're trying to solve some kind of kind of problem or goal on behalf of our counterparties. Like again, the way we think of the world is, the distress world, for example, is very much like, hey, there's a fixed pie, right? And I want to like get as much of the pie as I can, right? And the way we behave with all our counterparties is kind of to be opposite. Like, can we make the pie bigger, right? Is
Mm.
there a way for us both to win? And that's how we approach it. I think that's why our counterparties kind of, once we do a transaction, we're hopeful that they'll like come back and do another one because, well, again, it's fairly specialized. There aren't a lot of people out there who do it, and also because we created value for ourselves, but we also created value for our counterparties.
And then I'll circle back for a minute, right? You're saying you have this teams doing all this. How big's the team? How were they segmented? We
Yeah,
don't have to get too in
yeah,
the nitty gritty there, but the team's
yeah,
got to be extremely talented to be
yeah.
figuring all this out.
So the longevity team, again, we have like that's a very big team. We have servicing, which is I think over 20 people. We have probably about the same number working on between portfolio management, underwriting, origination, things like that, on that team. And then there's obviously kind of a few senior folks on the PM side. The special fits team is about 6 people just on just on doing the bilateral transactions. Multi-sector credit team is similar size. Our institutional credit team is has roughly 10 analysts on it currently and several PMs. And then on the and asset base really falls into our structural products team. So that the private and the public are done by the same people, right? So we have and then the real estate team, again, I think, low double digits, like, more than 10 folks on that team working on origination, legal, and all that stuff. And so, it takes bodies.
That was
It takes
20
bodies,
plus
right?
10 plus 150-ish plus, but
Yeah, I don't. I'm not. Yeah,
someone add that up. Yeah.
yeah.
Which
I think
don't
it's
answer
unfortunate.
this, but which is your favorite team?
Oh, I can't answer that. Well, but that's like the best part of my job actually is that I get to do on one day of working on a transaction where we're writing we're like signing a 200-page document and wiring money to someone, and on the next day I'm working on something where we're trading, a bond that's like, you traded, you're done, right? You bought it, you got a trade ticket that clears, and those are very different activities, right?
Yeah.
And we kind of do those and everything in between. And for me, that's the fun part. The fun part is the diversity of things we do, not just in the underlying risks, but also in like the nature of the transactions, right? Some things are like you work on them for a year, or you work on a structure for a year, you finally get it home, you're like sign a document. It's like a bit, that's a great moment. And then other things, you're like, you're trading them with some regularity, right? And it's not like a 2-year process to structure it up, right? The structure is pretty well known, and you can transact in the product. And so, to me, that's the fun part, is that diversity of stuff, right? Both on
keeps you
how you're
coming
doing
back.
it and what you're doing. Yeah, and it keeps you sharp, right? Because
If you guys weren't doing this, who else is doing it? Where's this happening elsewhere? Inside investment banks, inside Goldman, inside hedge funds, all the above.
I don't, I think there's very few places where all of this is happening in one place. There's competitors in all these markets, right? And I think as you go into the credit, as you go into the more, I'll describe them as like, CUSIP standard products, right? Where you go to the more things that are syndicated. There's a bunch of banks and a bunch of asset management shops doing that stuff. And again, I think we try to be differentiated in the way we approach it. Like, for example, we have some products which are, they're basically like the sandbox you have is all the kind of the entire product space, right? So you say, hey, allocate to us. We will figure out within this little part of the market what is the most interesting investment, but give us the freedom to do that. I think a lot of the competing products in that space are super specific. They're like, oh, I will buy, only CLOs, only AAA CLOs. And like, I think we want to be more kind of thoughtful of that and say, hey, we want to, like, some days that's not going to be the most interesting thing out there. And we want to like have flexibility to be able to allocate within, given a certain credit quality within the various markets. And so we design our products to be a little bit more kind of allocator driven, not like, hey, I want access to this one very specific investment, right? And so that's kind of
like a beta versus an alpha, or even outside of alpha. It's like, here's what that client, that allocator is looking for.
Yeah, I think it's like, it's like almost. I mean, I guess it has to be alpha, but like, exactly right. Like, we're not trying to be beta on anything, right? We want to be alpha everywhere as much as we can, and so do this thing that's slightly different, but and again, give us the freedom to kind of operate in the space, right? But you'll get this, instead of buying IG corporate bonds, you can buy all these other things that are also IG, right, investment grade, right? And they're not corporate bonds, but we think the risk reward is way more attractive than that, right? And that's basically the pitch for those products. But I think so there we compete with like, this entire universe of people, but I think we try to design a product that is relatively unique. So if you look at the products that look exact like ours, there's like, you can count them on one hand, right?
Yeah.
And so I think we're trying to be different by in that way. I think so same thing like,
Yeah, and I asked the question partly. It was less who competes with you and like where, if I wanted all these, each of these pieces, it's all at a different place, it seems like, right?
correct. I think that's
Yeah.
right. And so like can you go to
If I was trying to order it
retail?
a la carte, I'd have to go to a hedge fund to get that piece. I'd have to go to a bank to get this other piece. I'd have to go private credit somewhere, some other thing.
Yeah, and I think again, so on the credit side, I think there's plenty of capable players out there. On the insurance side, I think, particularly in the longevity space, I think I would observe that there's a limited number of managers that have scale, right? There are some, but again, it's if I count them on one hand that actually have scale in these spaces. There's lots of other competitors that we think of that are like much smaller, right? Like they may have, 20 million bucks of AUM or something, and so there's this kind of dual equilibrium of like a small amount of large players and many tiny players. And I think we try to be we try to have the most complete offering there, meaning we can originate, we can service, we can underwrite, we can trade, we can from the day the asset's created to the day it's gone, we can do everything in that space. Lots of our large competitors, they outsource significant portions of that. We don't really outsource anything, and small competitors don't have the capabilities to do anything like servicing, for example. So that obviously has to be outsourced as well. So I think we try to do as much in house, and I think and just like the why on that is because, like for example, servicing. If you do it in house, it's not a for-profit business, right? We're not trying to like contact do the servicing at the cheapest possible cost and the cheapest possible effort. Like if we do servicing and that prevents us from kind of doing a bad trade,
Hmm.
that savings or the P&L that we're going to get from that like what happened there is probably like paying for that whole servicing operation for
And
some period of
servicing
time.
is like processing payments and
Yeah,
telling
managing that.
people
Yeah,
they owe this
exactly.
money and that stuff.
Yeah, all the details, right? All the little
Yeah.
details of these assets that you have to look at. And again, like it's not a profit center for us; it's a cost center, right?
Yeah.
And so their job is to help us make sure we don't make mistakes, not to process
Hmm.
as much as possible with a little bit of
Or
that.
do you get the intel of like, hey, this one, these payments are starting to lag behind, or this is not starting to
No,
not look good. Yeah.
that's exactly right. And so so having that internally is I think we think a differentiator, right? And so we try to do that as much as possible, like kind of be as close to the assets as you can be, because there's like information there, there's you know indicators of what's happening, of the way things are going, and you can and again, if you're hands on, then you can respond to that, right?
Yeah.
You can amend, you can you know f- tweak transactions, change things, like again in the constructive ways, such that you're like you end up having a hopefully a better investment than if you sat there and did nothing, right? And so I think that's a
Also
very
sounds way better on a due diligence call. Like that line, we're much closer to the asset, right? We're as close to the assets as we can be. Sounds better than like, well, we don't touch the asset. It's a 10-foot pole and we have no idea what's going on over there.
yeah. I
Mm.
think that we hope so. We certainly
Yeah.
hope so, right?
And
So
then when these are you guys actively out there searching for these, or are they brought to you by third parties, or a little bit of both? How does that work of how you kind of fall into, might be the wrong term, but how you discover these opportunities?
yes is the answer, right? But it
Yes,
happens
all the
both
above.
ways.
Yeah.
But like the special sits is a good example. So the special sits group, before before I joined the firm, was a very insurance channel driven originator. So like they had a bunch of touches points on the insurance side of the business. They talked to those like that whole ecosystem of people, and then kind of when I joined, what I brought, and then some of the others who joined since then have brought is like a capital market side, right? So sometimes things are being banked, right? Like there are things that happen via insurance channels, and there's other things where it's like, oh, there's a financial seller here or a financial counterparty wants to do something, and it's being banked by a bank, not by an insurance broker,
Mm.
right? And so we see other kinds of originations again with risk that's not crazily different than what we were talking about on the insurance side, coming through both channels. And so I think we strive to actually like that's kind of a point of for us, a point of differentiation, because we're trying to, you know, like if we don't care where it comes from, right? We just want to see it.
Yeah.
And so like touch as many of these parts of the market as you can. And again, you'll be in the flow, right? So and then once you're in the flow, you get, then things kind of also, so you're doing outreach, but once people recognize that you're involved in the space, then you see calls coming the other way too, right?
And you
And
gotta be
sometimes,
careful. Like when I get emails or a guy calls up and is like, "Hey, I've got this great deal." I'm like, by the time it got to me, you've probably ran out of everyone good. Do you have to be careful of that? Like if the bank or whoever's bringing it to you, like my
yeah, like
natural reaction is like put up my guard a little. Like, well, if you're trying to get rid of this, what's wrong with it?
yeah. So I would say for example, on the reinsurance side, right? Like Um, there's lots of big global gigantic reinsurers out there who can, look at the risk and decide that they don't want it. And like, yeah, you worry about adverse selection, right?
Yeah.
And so like with the way we try to approach that is a couple different ways. One is we try to do kind of what are called like diversified or whole account transactions, where you take a little sliver of a bunch of different risks. And so you're diversifying your exposure on the way in, and so that means you can't massively outperform. But what it means is also that like the kind of the outcomes are relatively hemmed in, because you would need, a bunch of things to happen the bad way in like 25 different in 25 different businesses for like the whole thing to actually go, the wrong way in scale. And that's a lot harder to do than if you're just doing it for one of those businesses, right? And so we try to
Yeah.
diversify in the transactions. And then I think the other part of it is, um, you know, a lot of the times, there's other factors. So it's like it's either speed, right? So while there's lots of large reinsurers out there, they are generally not fast moving. And so if there's a tight deadline or something like that, we can be responsive when those institutions with their processes really can't be. And so that's one. That's
And it's an easy, quickly, is an easy definition for reinsurance. Just it's something the insurance company doesn't want or can't handle on their balance sheet. And right, if they're coming to you and saying, "Hey, I've got whatever 200 million over what I want. If you want to buy it, you're going to reinsure it."
correct. Yeah. So
Yeah.
they might have too much risk for their own liking, and they'll find partners, capital partners, who will share that risk with them. That's what reinsurance basically is, right? You're,
Yeah.
you're sharing risk with the
But I'm saying is any deal that's brought to you by an insurance company reinsurance or not necessarily?
not necessarily, but
Yeah.
like, again, the name is almost doesn't matter, right? It's an insurance contract for an insurance company, so like
Yeah.
all it's changing is who the counterparty is, right? So it's like it's just another form of insurance. And so, but what I was going to say is, and the other way that it comes to us is that it's not fully baked, right?
Mm.
There's a goal that someone's trying to achieve. They haven't like fully resolved how they're going to achieve it, and these are the ones that take longer, right? But these are the ones where we also get a lot of kind of reputational capital out of them, where
Yeah.
you work with them jointly on like creating the way you get home, right? And it has to work for us, it has to work for them, but you're having a dialogue. It's not someone's coming to you with a here's the like thing we want to do. Do you want to do this or not?
Yeah.
Right?
Sign here.
Yeah, I think more often than not, we do the other thing, which is, oh, here's this issue. This is kind of what we were thinking, and then there'll be a iterative process with the counterparty that goes on for 3 to 6 months or something, and you come out of that with a relatively unique solution, and again, which we hope is replicable, right, with other counterparties, but is worth it if we just do it with them. But that's how we get basically repeat business, right? Because if you go through that process with someone
Yeah.
and you came up with a good answer and they're happy and you're happy, like
Next time they're like, "How do we figure this out?" Call Peter.
they call it,
Yeah.
they probably call us. Yeah. So that's what we really try to do. But that's not, those aren't always, those happen not as regularly as we would like. Right. And so there's all the other stuff that you get through normal channels as well. And I think even there though, we don't just, again, it's rare that we like, again, liquid markets aside, it's rare that we like just take a transaction and accept it, right? You're always somehow negotiating some parts of it with the counterparty to kind of, to achieve our goals. So even if we're in a, let's say it's a being, either being brokered or banked or whatever you want to call it, transaction, there's normally back and forth about like what's acceptable to us if we want to participate. And again, and oftentimes, even if it's being like distributed to multiple investors, it might be a small number of multiple investors, and so you have the ability to actually make those kind of comments and get those kind of changes, and that'll be an iterative process there too. And so again, that the structuring, like the back end structuring of these risks, is a part of the in our minds, right? Like if I can forget about like what I'm making in return, but if I can hem in the risk, that's just as valuable as getting better return,
Yeah.
right? And so a lot of times we're focused on the return is fine, but can we make the risk way better for us or somehow defensive for us? And that's where we end up spending a lot of time, because if you can accomplish that, then the return is that much more attractive because on a risk-adjusted basis, it just looks better, right? And
Is
so,
that twofold with both those efforts, the underwriting efforts, basically, and then let's not just have one big, huge special situation. Let's do many and many of them.
yeah, I think there's always there's the fundamental underwriting on the way in, right? Which is the key. Like you go underwrite the thing and decide whether you like that risk or not. And then there's the structuring on the back end, which is can I make it defensive? Can I make it, kind of somehow more appropriate for or better risk for my LPs or our investors in some way. And so we view it as there's two processes, right? There's the underwriting of the risk and on the way in, and then there's the structuring of it on the back end where we try to make it better, right?
Which
And
could be something as simple as we're first on the waterfall or last or however you look at it.
yeah, it could be little things, right? And we have a lot of transactions where the protections are actually not inside the four corners of the document. Like we've
Hmm.
taken, for example, we've taken someone's rights in a contract they had with someone if they fail to do something as collateral. And the reason we did that was because the person that had a contract, the company that had a contract with, was a very high quality counterparty. So if they failed to do what they were supposed to do, that was a way that our thing could underperform. And so we said, well, if we get the rights to recourse against that high quality counterparty, that's like another credit protection, right?
Yeah.
So it's like that's not like out, but it's not you don't see it as a part of it's not going to be like it's not it's not part of the actual borrowers kind of underwrite. You're not under you
Yeah.
don't it's a different thing than just underwriting the borrower themselves. It's separate kind of, and then by the way, it's two counterparties, so they both have to do kind of bad things for that thing not to work out. That's a joint probability. That's obviously better than any one of them doing the bad thing, right? So I think we try to do lots of things like that where we try to be creative to make the risk better again, which again, like the return should come with that,
Yeah.
but we're as focused on protecting, on
But then at
protecting
a
ourselves.
portfolio level, putting 10 of those lower risks
Exactly.
together, right?
Yeah,
Then
yeah.
like what's the upper limit of that? Just as many as you can get your hands on or some
I
target
mean,
number?
yeah, I think on the special sit side, like we think that fund probably has, whatever, 20 or 30 positions, right?
Hmm.
Maybe 40, right? But that's like, given the scale of funding, given the scale of the opportunities, that's like as much diversification as you get, right?
Yeah.
And I think that's fine. It's not a, you know, broad index kind of situation, right? It is a
Right.
special situation, right? And so, but I think inside those transactions, though, there is internal diversification. So lots of times, you know, the performance of those transactions again will not be reliant on a single counterparty just doing something. It'll be reliant on, whatever, 1,000 insurance contracts or, 10,000 policies or something like
Yeah.
that. And so
Yeah.
you'd have to have like a kind of a larger systemic thing happen for there to actually be a performance problem. And so you have a little bit of internal diversification as well, right? Because the nature of the transactions themselves aren't just like I lent money to some company, right? They're somehow you know have underlying assets that are not just the credit quality of that
Right.
counterparty. Yeah.
Layers upon layers. Let's pivot here and talk about either some of these special sits or we can go to, yeah, let's just a couple of examples of what's going on in special sits. Or
Sure.
if that's in multi-sector as well, but
Yeah,
there's
sure.
kind
I
of
mean,
a, yeah.
on the special side, I think one interesting transaction we've been involved in is we partnered with a provider to provide letters of credit to companies, right? And this is one where there's like additional protections. And so, because of the circumstances of the letters of credit, we think that a lot of times in bankruptcy, they won't even get drawn. So even if the company files for bankruptcy, right? There's a large preponderance of instances where the letter of credit won't even get drawn because of the way the court process is handled and
Yeah.
because of the allowed things that the bankruptcy court will let the company do. And so that's like this weird outside of the credit. There's no like security, right? But we think even if you file, you're like kind of senior to the first lien term loan because if they file, the first lien term loan could be haircut. But we're saying our instrument might not even get drawn. And so it's not perfect, right? Because you could have other situations where it will get drawn,
Yeah.
but we think there's a large set of instances where it won't be, and so that's all of a sudden a way superior credit instrument, right? And so we're and but the thing here is you can't I can't go to some bank and buy that, right? We have to it has to be originated, and so we worked for better part of a year with a partner to originate that product, to work with them on kind of a partnership where they originated it. We're taking the credit risk, and we work together on underwriting the credit and all those things. And so that just setting the whole thing up took a year, and then it probably took another year just to ramp assets, right? So we took kind of invested 2 years in this thing. Now we invested because we hope there's lots and lots of more of that to do. But my point there is we have to come up with like you have to originate that thing. That's not trivial, right? And so they happen to be in the business where that like they are close to those processes, and so that's why we partnered with them. But the things that are difficult to originate, right, are another kind of reason, right, or another place where we tried to be different. Like, oh, it's hard to originate. Let's figure out how we can do that, because we think the risk is really good. We'll take that risk. And so here we did that partnership because of this unique characteristic associated with kind of the context of the letter of credit, right? It has nothing to do with the actual. It's not in the letter. It's not in the document, right? But it has to do with like who it's present to, who it's actually benefiting, and under what circumstances will they actually draw it, and that's all related to kind of why it exists, right?
Yeah.
So it's again, it's like it has nothing to do with the credit quality of the counterparty, right? Well, that's the first thing you look at, but the reason we like the structure is because of the like why it exists, and that's a completely different thing, right? And so again, I think it's kind of multidimensional in that way, but that's like the special sauce, right? That's so
Yeah.
so
Yeah.
why it's good because of that, and so we'll go,
You
you know,
got
we'll
the President Kennedy line pinned up somewhere in the office. We do it because it's difficult, not because
yeah,
it's what's the I'm
I
butchering the
I
line. You know what
I
it's
know you're right. Yeah, we do it
we
because it's
don't do it
hard.
because it's
Yeah,
easy. We do it
yeah,
because it's hard.
that's like I should get that for the office actually.
Right? You have to do it in the
um,
Boston accents because it's hard.
yeah, but that's a good example of that's a more credity product, right? It's not very insurancy. But what makes it interesting is because the instrument is something special, right? There's something unique about how we're doing the risk transfer that somehow differentiate from just going and buying, the corporate bond of that company, right?
Right.
And so that's a good example. I would say the other things going on in special sits are we have loans where the collateral, like so we may lend to, let's say, people who are this will be an insurance thing again, but they might be like someone who like a large insurance company pays. Like imagine if you had, you know, pick your gigantic insurance company, and they have a broker that works for them, and they pay that broker commissions regularly. Well, it, that's the what how much those how those commissions like sustain, and how if you have have you have a dollar commission today, what does that mean for how will you have a dollar, how much will you have tomorrow, next year, and year after that, and year after that.
Yeah.
That's an actuarial analysis you can kind of do.
Hmm.
And so what that means is you can put a value on that potential stream of commissions that again requires kind of actuarial science, but we're going to use it as collateral, right? We're going to say, okay, we can value what we think that stream looks like. We think it's it has some value, and we can use that as collateral to lend. But we're lending maybe to an institution that isn't as good as the payor here, right? So there's a big insurance company paying a little broker, right? And the big insurance company might trade at 5%, right? On like a structurally junior part of their debt might trade at 5 or 6% or something like that.
Yeah.
But they're a very high quality counterparty, so we could take the payable from them as collateral, right? And then but the borrower here is not that company, right? It's their cost of capital may be 15% or something, and so we can charge them something better than 15, which is why they would do it.
Yeah.
And but we get this, but again here, so we can get, let's say it's 12, right? We get a 12% return, but we have collateral that,
Which is basically if they default, the insurance company will pay you direct instead of the
yeah,
broker. Yeah.
exactly. So we like kind of that's the hard
Mm.
part is how do you
Yeah.
structure that? Like
Right, right.
how do you like make sure the funds go
How
where
do you
you
even
want
get
them
them
to
on the
go?
phone? Seems like the hard part.
Yeah,
Yeah.
but how do you make sure that those commissions go to a place where we have access to them if we need to? That's the detailed structuring that you got to do. But
And then
the
like registrations and all that stuff involved in that too. Got it.
100% and like and
Mm.
so like and I think but the fundamental principles. So there's a lot of complexity and noise around that stuff. But the reality is, what's the thesis? The thesis is really high quality pay, or I can take receivables from them. Those things trade at like mid single digits, but I can get paid low double digits to lend with that as collateral, right? So I risk reward mismatched. And again, the the hard part here in that space is making the thing, going and
Yeah.
originating it, going and it is like I can't pick up my phone and call my local, giant broker dealer and be like, I want to buy that because it doesn't exist, right? You have to go make it. And I think
Mm.
again, that's the hard part. There is so it's some combination of, hey, I'll do this combo of credit and insurance stuff, and I'll go like find a way to actually originate it somehow, find a pathway to actually create the asset itself. And so that's another one. And then we've been doing a lot in the reinsurance space as well. So there's the big like the fundamental picture is, and this is only going to get worse with the recent hurricanes, I think, is that you had a couple of catastrophes a couple of years ago. You had a bunch of global insurers say, hey, we want everybody to kind of co-invest, right? So if we're ready, you reinsurance, we're insuring you. We want you to keep some risk on yourself. And so there's this like just there's a dearth of capital
Yeah. You can't
in
just sign a bunch of hurricane in the Gulf and Florida and resell it all. Basically, they're saying no, you have
yes,
to. Yeah. Yeah.
yeah, you keep some, right? Or I don't want any anymore,
Yeah.
right? And we don't really do cat. We do mostly like auto liability, general liability, things like that. But there's a ton of capital for all those things, right? And so what we can do is we can go in and as an investor, we can be more discreet in our investment. So if you're an insurance company, you write an insurance policy, and you don't care if you pay. I mean, you'll be around. You have like an operating company, right? And so you're around to pay claims, right? Whether they were originated last year or 2 years ago or this year, like that's like you're not as discreet about that. You kind of have a running book all the time. We can go in and say, hey, we will support the writing of insurance for a year, and when the year is over, like that investment is over, we may decide to do it again next year, but we may do
Mm.
that out of a different fund, and we may do it out of a different vehicle. But this transaction will only be in respect of
Right.
the
Then you
stuff
don't
you
have a
originate.
big short put, basically, right? Yeah.
Yeah, well, you like
Open ended, always on.
yeah, so that's what we're not doing, right? We're not like
Yeah.
on the hook. We can choose to remain and do it, and from a commercial perspective, we try to do that, right? We plan to do it next year, right? But this particular investor base isn't automatically rolling
Yeah.
next
Yeah.
year, right? And so that's the unusual thing, right? Is that in that space, like doing that discreetly, and then designing the mechanics around how you get your capital back and when it comes back and how it relates to when the claims are actually being paid. Those are the complexities there, and that's the hard part of doing it as an investor, right? Because if you're like an insurance company, you just say, yeah, I'm here, I'll be here. I don't care necessarily about me getting my capital back because that's like a internal budgeting exercise. It's not an actual like return of capital for your investment. For us,
Right.
it actually is a return of capital for our investment, and so we really care about all those mechanics. And so that's where in that space, we try to do that, and then we try to kind of to design them so that we have while properly collateralizing all the risk, we have attractive like terms in terms of getting our capital back out, right? Or at least it's just that the expected returns of these things are attractive for investors. That's been a very busy space. I expect it'll be busier because of this. One, when you have these like large losses, there's always implications, and two, the market was already kind of pretty hard, right? So there was
Yeah.
already a capital problem. not a discount problem, but capital. Like there isn't free capital everywhere for everybody. Yet the market was, pricing was going up, and so that demonstrates that there's kind of a shortness of capital, and so that only normally these big losses exacerbate that, and so we see it as an ongoing opportunity going forward as well because of because of the happenstance what's happened
Yeah.
this year.
What do you, this is maybe outside your expertise, but just given your standing in the insurance space, what do you think happens to that Gulf of Mexico, Western Florida, or maybe all of Florida insurance market?
I mean, like the Florida market's been challenged already. Like something
Yeah.
like a giant percentage of the insurance in Florida is already done by the state, right?
Hmm.
And so I think there'll be that's not a new problem, right?
Right. So it'd all be like state or even federal
Yeah,
backed in
you
some
might just
manner.
have more going that way. And by the way, anecdotally, like the homeowners market has been just hard too. Like we've heard, anecdotally heard lots of like indications that you know that the large writers are pulling out to various states, and so it feels like there's given, I guess, both social inflation and real inflation in terms of repair costs, right? People were thought they were not charging enough for the product, and maybe they didn't get the approvals to raise rates as much as they thought they should be able to, and so you have people pulling back in the space. I that just probably is that it certainly doesn't get better, right?
Yeah.
After these kind of events, so I think
Just kind of all the obvious stuff. There's nothing crazy, right? Just like,
and
yeah.
so we normally don't. So a decent part of what we do because of the credit investing expertise is longer dated lines. So a general liability, right? Like you have a whatever restaurant, someone slips and falls, they might sue you.
Hmm.
That might take 3 years to actually get paid, right? And so that's a longer line of liability. We normally do those because you invest the capital while you're waiting, and so
Yeah.
that gives you a buffer against performance, right? Because you invested, you have return associated with that investment, and so that gives you like kind of a buffer against under the insurance side not being exactly what you thought it was going to be. On the things like homeowners, it's much shorter, right? You have to get the underwriting right because you don't have that time to invest the money, right? You only might have 18 months or
By
something.
law or just expectation, or how does that work? The laws are different, like for a
No,
homeowner.
just the product, right? Like if your
Yeah.
house gets damaged, right?
I need
You
that
like
money. Yeah.
call your insurance company. You're like, I'm going to fix my house, right? That
Yeah.
doesn't take 3 years, right?
Mm, right.
Or it
Yeah.
shouldn't. Well, it shouldn't take 3 years. It might take 3 years. You have to like go sue for that. But like, regular way, like, hey, whatever, something happened to my house, it got damaged. I want to file a claim. That takes like weeks or maybe months,
Yeah.
not
Yeah.
years, not years.
Right.
Things
What
like
happened? Let's send someone out to see what's going on. Yeah.
exactly, yeah.
Yeah.
So like just by the product, like it's shorter tailed, and so because of that, right, you don't have this buffer of insurance return of investment of interest and investment returns to like offset losses. You're just paying out now, and
Yeah.
so that's why we tended to not be super involved in that space. But we're even looking at it. We're looking at it now because we're here. We see all the challenges. And we're like, well, maybe you have an opportunity to get the underwriting right,
Hmm.
right, and so you can make it a profitable line, right, and I mean, again, we haven't like committed to doing this, but like that's kind of what we're thinking. Is like, oh, at some point, right? And I think you have the opportunity to get the underwriting right, right? Because the difference is like you have to be super correct on the insurance side of that
Yeah.
business. And so we're like, well, maybe you have the opportunity to actually get that right now because it tends to be challenged, and so that maybe that's the risk you're willing to take, right? But that just gives you some context for how the industry is set up right now.
Across the whole book, your other two most unique, coolest, whatever word you want to use.
I'm trying to think of one. No, so on the like we have on the asset based side, a very simple one we have is I'll say because it's different. We have a program where we originate consumer loans that are focused on medical care, right? And so the idea there is that people tend to pay for medical care, so the default experience must be better. We basically provide capital for again an originator that focuses on that space to originate those assets where they're effectively done at the point of sale, right? So you will you're at the like medical office, and you're like, I want to, it's not covered procedure or something, and I want to, do you want to, you can finance that like as you're checking out,
Mm.
and
Like
so
almost like a firm or something like
yeah,
yeah.
but for medical procedures basically,
Oh, nice.
and
All right.
so that's something we have, and we have a kind of open, kind of ongoing originations there, and again, it's a pretty short asset, so it has, you have to recycle it a lot, and but it's a very different, that's a very different kind of underwriting than what everything else I talked about, right? It's a highly driven
Yeah.
by, and I think again structurally there, the idea is, by the origination, I guess, like the context matters, right? You might, this same borrower might not, you know, have the same propensity to pay you back if they were, buying sneakers with the money or something,
Right.
because it's like to do something medical that they tend to be more thoughtful about those liabilities. That like kind of comes out in numbers, and you see that performance, and so
That's crazy that you have to kind of get into consumer mentality at that point, right? Of like, what are they
yeah.
more willing to pay?
Well,
Yeah.
but again, I mean, that's, again, that's kind of, we're not the specialists. We're working with the specialists, but like
Yeah.
that's what you have to look at. Say how does
Yeah.
it
No,
actually look?
nobody's coming to repo their Nikes, but yeah,
Right.
they're gonna.
Exactly. And so, and so it's like that's again, so you look at you look at the specifics of what's happening. You look at, why does this transaction exist in the first place?
Hmm.
Is that constructive? Like, do we think that's a good or a bad fact pattern? And can we give like some credit for that in the underwriting? And so that's another example of the kind of, that stuff. I think the other very unique one, if unless you want to give the questions on that one, or do you want me to?
No, that's good. Yeah.
The other one is litigation finance, where it's like you know, you have relationships with law firms where you basically kind of advance them money, to to prosecute, some lawsuit, or maybe it's already settled, and you're just
So
advancing them on the settlements, which is the more common thing we do.
like Camp
And
Lejeune, all those advertisements
so,
and whatnot.
yeah, so that's a very well trafficked one, right? Because that's exactly why you see that, because campus is interesting because it is basically settled. The government has
Nice.
said we're liable, and the government has said how much they'll pay you. And so the reason you see a million ads for Camp Lejeune is because it doesn't have the risks that are typically in place for these
Mm.
kinds of assets,
It's
right? It's
basically
like,
zero risk. Yeah.
yeah, it's like the payer is the government, right? And they like kind of like have said effectively
Yeah.
that,
We're not appealing. We're just all right.
yeah, and this is kind of how we think people should get paid. And so the reason you have so many people going after that is because, is precisely because of there's all the risks that typically exist in space, like, oh, you might the payer might not pay, they may decide to file for bankruptcy if it's a really big case, or or the or your particular lawyer's bucket of cases might not do well in the settlement or something like that. Those are all things that are kind of not present in that situation, which is why you see people aggressively chasing it, is because it kind of doesn't have all the risks associated with that. So that's a space we probably are in the most, I would say, the least risky parts of that space. So we tend to do things like after they're settled, or things like that, where the outcomes are relatively well known, and so you can kind of somehow underwrite it. It's more of a timing assessment than it is will or will it not happen, right? I think there's a whole spectrum of those kinds of things that go deep into, like, you might not win. For example, there's parts of that market where, they may not, you don't know if you're going to win the lawsuit, much less get paid on the claims. We tend to focus on the final edges, where you're really just kind of advancing against known receivables,
And is it
right?
these like huge law firms, right? Or could you have some single person? Like I'm thinking of the Grisham book, the
It,
Rainmaker. Remember
it,
the movie with
yeah,
Matt Damon? Like he needed you guys. He needed someone to be like, "Here's the money to fight this thing."
it tends to be
Yeah.
more institutional counterparties there, not individual.
Not Matt
But yeah,
Damon. Yeah.
yeah. But
Wait,
again, I
so
think
then,
so. To be focused on the most, kind of on the like, most of the facts are known. Most of it's like there might even be a settlement already done, and it's just people want to kind of, um, kind of get access to their capital sooner, right?
Mm.
And so we that's kind of where we focus in that space.
Oh, so it's not even like for marketing and advertising necessarily. It can just be, hey, I'm gonna have this many clients. I know it's this much revenue.
It can be for a variety of things, right? I mean, but I think the point is that it's like it's just the like we tend to want to be able to somehow think about underwriting the risk, and so when it's a timing assessment, right, where you have more certainty on outcomes, but it's just a question of when those outcomes will come. That's kind of underwritable. When you get to like other parts of the market, it's harder to underwrite. That you actually have collateral. The returns are much higher, but you could get a zero. But I think we are like always thinking like credit investors, and so we're thinking about recovery, right? If it goes bad, and recovery if it takes longer than it's supposed to, right? Isn't
That's
it
the
zero,
risk.
right?
Yeah.
It's just your returns lower, right?
Because it's spread out over a longer period. Yeah.
Yeah, as opposed to like in other instances, if you're like there is not none of the facts are established or there's still litigation going on, like there your recovery could be zero.
Mm.
And that's where we kind of go like, okay, that's like we don't like that profile basically, right? We'd rather
We
have
don't like zero.
yeah, we don't like zero. I'm wrong, but that's like a good point. Like in all these spaces, right? We kind of say, if it goes bad, right? We want to have we want to have some high or a reasonable recovery.
What
And
is
so
bad?
again, that's where the like credit investor mindset comes in, right? And I think again, like in a variety of these spaces, there are products that are zero recovery products that we won't play in precisely because of that risk preference. And so that's where I think again we're thinking a little differently than a lot of investors in the space, where they might do things because they're diversifying. They may be like kind of negatively asymmetric, right? But they're diversifying, and so the price you pay is that asymmetry. We kind of try not to do that, basically, right?
And so, you're not responsible for the proliferation of personal injury lawyer billboards here in between Chicago and Indiana? They're like every other one.
I think those were around well before we were involved.
Exactly. But it sounds like that's not the kind of litigation anyway. There's no litigation there. They're trying to drum up the business. Let's spend a little time before I let you go on longevity. I think that's probably the thing people most know of kind of in the insurance world in terms of an investment possibility. So you said it's both long and short? How
So
does
I
that
think
work?
traditional longevity investors would buy life settlements. They would just you buy the asset, you think it's cheap, right? And so you think you're going to get a good return. And so I think but that assessment in theory you could be wrong, and it could just you may not get what you thought you were getting, or the probabilities you thought could be inappropriate. And so that's a very directional trade. It's like saying, hey, I think Apple stock is cheap, right? So I'm going to buy it. Well, if you're wrong about Apple stock being cheap, you're going to lose money, right? And so it's a similar dynamic here with just more complex variables, right? If you just buy an asset you think it's cheap, that's one strategy, and that's been the strategy in the longevity space.
And how do they view it as cheap? It's based on a pool of lives or a single life?
Yeah, I think it's based on people will have life expectancies, and there'll be probability curves, and they'll assess like, hey, here's various points of time. If you have mortality here, here's where it happens, and you will. But that assessment is really what drives it, right? And so those probabilities could be wrong, right? And so I think.
But is that wrong on like a broad of all of America, or a section of America, or a specific person?
Again, I think all these portfolios are not. They're not betting on the entirety of America. They're betting on the portfolio, right? So one, portfolio construction, you want to have a diversified pool because, like, any one is always going to be wrong.
Yeah.
But the question is, when you have a diversified pool, will that on average be right? And that's kind of the experience we have. Is on average we try to be very thoughtful and get that right. But the point is, if you have a change in technology or medicine or whatever, that can have dramatic effects here. And so what we're doing now is also running a book of that benefits if, and you can do this in the life insurance space where you can there's a variety of instruments that will benefit if there's a longer longevity. And so you can buy those kind of instruments alongside the ones that are hurt by longevity, and that will result in a more balanced book, right? And so I think we're striving to do that now, where we're trying to run it more as a kind of a long short strategy, so that you could, and then in theory, if you think about like in the option world, or right, if you do the long and the short, you're supposed to get the risk-free return, right?
The straddle, yeah.
Right. But my point here is that these aren't liquid markets, right? And so if you do the long and the short, you actually don't get the risk-free rate. You get like a decent, like a double-digit return. And so that's the key. Like, why why do it directionally? That may be a nice return, but if you can also do it less directionally, right, and get a similar return, like
let's do that.
Right? Let's do that instead. And I think that is the strategic shift that our longevity business has taken in recent years, is to say, okay, maybe this asset class, it's matured, first of all, and so that's part of it, and so there's it has a larger investor base, so maybe it's really you can't source it at the kind of target returns you once had, so then maybe then the directional strategy made sense, but today you look at it and you go, okay, the strategy of being kind of less directional probably makes sense, and I think that's where we've put together what I think is a pretty unique strategy, because most people in this space don't. You have to have the infrastructure. So we own an insurance company. You have to in order to get the risk the other way, it might require certain licenses that people generally like in this space don't have, right? And so we've tried to build the infrastructure to allow us to basically be a longevity mortality investor, and to be ultimately form agnostic, right? To say I can do this in a derivative form via a swap. I can do it via some kind of insurance contract. I can do it by buying buying a life settlement for someone, and to kind of just be agnostic on how you're doing it, and assemble a portfolio of risk that's that's exposed to these things, right? But isn't all one way, right? And then I think the returns are basically you can get pretty good returns doing that strategy, and so kind of we think that's the prudent approach to take.
My main takeaway is you're kind of doing what the insurance companies are scared, too slow, or too regulated to be able to do. Is that a fair assessment?
Yeah, I think we try to be. Yeah, I think we try to be in the space, certainly more nimble. I don't know if I would use scared. Right? I think maybe.
I was gonna use dumb, but I didn't think you'd like dumb either. So somewhere between.
I think because of the flexibility of our capital, we're not subject to the same stuff.
Too inflexible. That's a much more polite way to say it. All right.
And I think that's the key, right? We have flexible capital. We can do things in a variety of forms, and that's a toolkit that most operators in this space don't have, right?
I'll circle one last. I'm an allocator. How do I view this? What bucket do I put it in? Right. It seems a little bit bucket list to me, but it's like a bond replacement, or how do you view it?
Yeah, look, we have longevity and special situations funds are really alternatives, right? That's how you should think about those. Our multi-sector the various credit products really are liquidity driven, right? So we have like the multi-sector credit stuff and the fundamental credit stuff. That's all liquid, and we have it in daily liquidity forms. And so on the more private credit stuff, we have, again, private credit vehicles that have they're private funds, but they have reasonable liquidity terms, right? And the same thing on real estate. Those products have private funds, but that are reasonably have liquidity in them, right? So they're not like closed end vehicles that you have to hold for 10 years. And so I think we really measure on a liquidity basis. So where we think there's liquidity, we offer products that are more more available to be redeemed quickly. And then as we go into the more complex and more liquid stuff, it goes through to kind of less liquid fund structures, and ultimately to the closed end fund structure.
Got it. I'm going to think of it as the income replacement, right? If I'm trying to do my pie chart at the family office, like, okay, which either in alts or income replacement.
Yeah.
But it's going to have more of that, right? It's going to have more of that type of profile, the income profile. What'd you say? Sure. And in the alts bucket. Yeah.
I said and uncorrelated. The people who tend to talk to us are either looking at the uncorrelated bucket. So it's not stocks and it's not bonds, it's something else.
Yeah.
That's a big bucket we get from allocators. But all of our stuff does cash flow. So you're right. Like as a general principle, right? Irrespective of liquidity, like
Yeah.
we're generally providing income, right? And that's a fair statement to make. And the question is,
Non-correlated income. That's the holy
yeah.
grail.
And if you want to, and again, and like depending on your return target, there's a different liquidity profile for you, basically. Right?
I love it. All right, Peter, we'll leave it there. Thanks so much.
Okay, that's it for the pod. Thanks to Peter and Obra for coming on. Thanks to Jeff Berger for producing and RCM for sponsoring. We'll be back next week with a retail option trader turned hedge fund manager, and then finish up our year with Zed Francis and Jason Buck, two close friends there, coming on to talk through lessons learned in 24, the election aftermath, and what 25 might bring. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.